All right. All right, well, this is the day before July 4th. All right, so we've got a celebration tomorrow. And we are kind of like day 3 into the second half of 2024. So this is very exciting. And I always get kind of excited about calculating these kinds of things and teaching people on how to make their businesses much better than they already are and get a better understanding of how things interact with each other. And today, what we're going to talk about are a couple calculations that I think are really important for you as far as that have a pretty big impact on your cash flow. The first one is accounts receivable days outstanding, as well as accounts payable days outstanding. So these are pretty important because, if you're collecting slower than you're paying, you're eventually going to run out of cash. So you need to either adjust for that through financing or change how you're going to pay so everything's kind of in equilibrium. And you can forecast that out, and so that's the importance of putting together those forecasts and budgets and taking this into consideration. But I can't stress enough how important it is to have accurate financial reporting coming to you as the CEO and the owner of your business. So let's go ahead and get started. We're going to talk about the interaction between the balance sheet and the income statement. And this is kind of cool. So the balance sheet, we have assets. And then there's going to be like cash, inventories, AR, as accounts receivable. Those are your current assets. Then you're going to have long-term assets. Underneath that, you're going to have total, of course. And then you're going to have your liabilities. Liabilities are going to be your payables. Those are typically current liabs. You're going to have your long-term liabilities. And then total liabilities. And then you can have equity. And equity is really the balancing. So assets are going to, this is the accounting equation, assets will equal liabilities plus equity. All right, so on the income statement, so here, you're gonna have revenue, you're gonna have your COGS, cost of goods sold, you're gonna have gross profit, you're gonna have your admin expense, you're gonna have NOI, and then below that, you're going to have below the line items like depreciation, interest expense, and other things like that. So, all right. So now we have our income statement and we have our balance sheet. And in the balance sheet, it's really a point in time, whereas the income statement is going to be a period of time. And what that means is the balance sheet is just what happened. What does everything look like at this point in time? Whereas a period of time is list all the transactions that occurred during that period. Now your period can be 1 month, 1 quarter, 1 year, so forth. So what we want to do is calculate our AR days outstanding, okay? And this is super important for cash flow, and what we want to do is we have a beginning period and we have an ending period. We add those two together. So I've already taken the liberty to go ahead and add those two together for you, and add them together and divide by 2. So that'll give you an average of what those receivables are between the beginning period and the ending period, and I'm taking a 1-year period of time. So we take those, add them together, divide by 2. That number comes to $697,500. Then we divide this by total revenue. And revenue is just a 12 months period of time. How much did you accumulate during that period of time? And in this particular example, it's 3.9 million. Okay. So what does that equal? That's going to give us a percentage. And so that percentage comes out to 0.18. And we want to multiply that by 365 365 days because that was the period that I took, was 365 days. If I would have taken a quarter, I would have done 90 days, and I would take the beginning period, ending period, and calculated what it was during those 90 days. But in this particular case, I think it's better to go out 1 year, and then you can multiply that by 365, and that number comes to 65 days. Actually, it's important that you can't do a quarter, you have to do a full year on these payable days, okay? All right, so then accounts payable is similar. So I've taken the liberty to take the beginning period and the ending period, divide that by 2, and that number comes to 345,000. And instead of dividing by revenue, we're going to divide that by our cost of goods sold. And that was $2,635,000. So that'll give us a percentage as well, and that's 13%. Multiply that by our 365 days, and that comes to 48 days. You can see there could be a potential cash flow problem with this because you're receiving in 65 days, but you're paying in 48 days. So either you have to go to your customers and say, hey, you need to pay us faster, or you have to go to your vendors and say, hey, I can't pay you, I gotta pay a little bit later. Otherwise, you could also bring in financing, cash flow financing, which are lines of credit. There's other kinds of factoring or accounts receivable factoring, those kinds of things can bring in that cash a lot quicker so you don't run into a cash crunch. But all of this, the balance sheet, the income statement, eventually flow over to the cash flow statement. And those are the things you need to be able to make really good decisions as far as forecasting and budgeting going out into the future. These are numbers that you want to take into consideration when you're making those forecasts, because as you plan your budget, you want to make sure that there's going to be enough cash to be able to meet all those expenses. So I have a Calendly link below if you'd like to talk more about this and you'd like to get your business under control and understanding and forecasted and planned better. Give me a shout out, click on that, schedule a time, and I look forward to talking to you. All right, take care.